Today, most Americans, including the ones listening to this podcast right now, are actively destroying the financial version of themselves 10 years from now because they don't care about themselves.
People talk about making a difference, but they don't. Because they don't try. They don't risk. You risked everything.
And before you shut this off, before you get defensive, let me be clear. I'm not talking about your current self. I'm talking about your future self. Because right now, almost every decision being made in this economy is being made for now. Not tomorrow. Not 5 years from now. Now.
That's right. And living in the now can be healthy. It can be authentic and it can be meaningful. But when every decision is made to protect how you feel today, your future self doesn't get delayed, it gets ignored. And ignored futures don't magically turn out to be okay.
Things are becoming a little clearer to me. Quite the sacrifice.
Yeah. That's what you both want. Hey, there's a reason this is happening. And it's not what most people think. It's not laziness, it's not irresponsibility, and it's certainly not lack of discipline. It's a condition, and it's called the dopamine dependency loop, or DDL.
Yeah, DDL is a post-COVID behavioral condition where instant relief consistently beats out long-term planning. Your brain is trained daily to chase comfort, convenience, experiences, and validation because those things reward you immediately. Saving, planning, homeownership, those reward you later. And in an economy where later feels uncertain, the brain chooses now, every single time.
Before you say, this still doesn't apply to me, let's look at the scoreboard. Credit card debt in this country is over 1.2 trillion. Auto loans, they're over 1.6 trillion. Student loans are about 1.7 trillion. That personal savings rate, it's only around 3%. That's not a strategy, that's survival.
Yeah, now listen to this and don't explain it away. The median age of a first-time homebuyer is now around 40 years old. I'm gonna say that again. The median age of a first-time homebuyer is 40. And first-time homebuyers, they make up just 21% of purchases, the lowest level on record. Let that sink in.
Yeah, that's the lowest level in history, forever. 40. Holy cow. That's not where you're supposed to start. You're supposed to be halfway down the track by now. But instead of riding the financial freedom train into their 20s and 30s, people are showing up at the station in their 40s. And when you arrive that late, the train doesn't come back around. It's a head-on collision with less time, less margin, and far more risk. And just like in Yellowstone, no one wants to go to the train station.
What are you doing? This ain't no goddamn train station.
Sure it is. A long black train.
So this is the first generation in modern American history where if nothing changes, your future self will be poorer than you are today. Not because you didn't work hard, but because your future self was never invited into the decision-making room.
And when people finally feel the reality, they don't say, I need a better plan. They say, well, and they spend. Because if tomorrow doesn't feel worth fighting for, why sacrifice today? And this is where people get it twisted. They say, the American dream is dead.
Yeah, I'm here to say the American dream is not dead. It is always lived, but in one place, your future self. What's dying is the willingness to protect that future self when it feels uncomfortable in the present. And if you don't protect them, no one else will.
Which brings us to the real question. Because to actually fix the dopamine dependency loop, to get off the track headed for the station that no one comes back from, you have to be willing to do one thing that goes directly against what your current self wants. And what it really understands is that you have to be willing to.
I'm just warning you. This Genie does not go back in the bottle. Neither does mine.
Hey, The math isn't against you, the timeline is. Anthony, tell us about this.
Yeah, before we go any further, we need to reset one thing. Fear is loud, but fear is not truth. And the fear of buying a home in today's economy is one of the loudest fears people are dealing with right now. But homes should never be bought on fear. They should be bought on math first and then your why. Because math tells you if it works, but your why tells you why it's worth it.
Let's talk facts. 2 years ago, early 2023, the median U.S. home price sat between $350,000 and $380,000. Today, in 2026, that number is closer to $410,000 or $428,000. That's a 10 to 15% increase without a crash, without a reset. That's the market we're operating in right now.
Yeah, and now layer in the interest rates. A few years ago, a 30-year mortgage rates were almost touching 8%. Today, in 2026, they're sitting around 6.125. It's still elevated, but materially it's better. And if the current trend continues to materialize, the rates are expected to move towards the mid to lower fives by the end of this year.
And here's where it hits home. The average monthly principal and interest payment has seen an increase over 21% since 2023, before taxes, insurance, or HOA. That's not crazy. That's reality.
Yeah, and here's what it actually means. This isn't a weighted out market. Experts are not calling for a crash. They're describing a higher for longer environment. Prices are rising slowly and rates are easing gradually. Affordability is tight, but it's predictable, which means homeownership still matters.
So if you're waiting for prices to drop meaningfully or rates to magically return to 3%, you're waiting on something that math does not support. And that's how people accidentally become statistics. Not because they failed, but because they hesitated.
That's right. And I mean, when you pair this together with reality, with a clear why for your kids, for your sanity, for stability, and for control, the trade-offs, they make sense because now you're not just buying a home, you're buying predictability in an appreciating asset and control over your future.
And this is where most people get stuck, because knowing the math is one thing, changing your habits is another.
He's back. The cowboy's back.
Hey.
Okay, Manley, let's talk about our next segment where our life doesn't need to suck. It just needs to leak less. Let's talk about that.
Yeah, Anthony, this is where most people hear change your habits and immediately think, so my life is just supposed to suck now? No, that's not what this is.
No, changing your habits doesn't mean your current life needs to be miserable. It just means it needs to suck less money out of your pocket. That's it. Because most people don't have an income problem. They have a leak problem.
And the leaks don't feel dangerous. That's why they work. Subscriptions you forget about, eating out because it's convenient, upgrading cars sooner than necessary, lifestyle inflation that quietly follows raises. None of that feels reckless, but combined, it steals your future.
100%. And this is the part people miss. You do not need to overhaul your entire life. You do not need to move to the woods, and you do not need to stop enjoying life. You just need to redirect small, meaningful amounts of money away from short-term comfort and towards long-term control. That's it.
Most people think the path to homeownership requires massive sacrifice. It usually doesn't. It usually requires fewer leaks, more intention, and a plan that lasts longer than 30 days.
Right? I mean, this is where the mindset actually changes, Manley. Not when people say, I'll do this forever, but when they say, I can do this for now because it buys me something bigger later. That's not deprivation, that's strategy.
And here's the key. When your habits change, your identity starts to change too. You stop asking, can I afford this right now? And you start asking, does this move make me closer or further from what I really want? That question alone, it changes everything.
Yeah, and this is where the future self finally gets a seat at the table. Not because you stopped living, but because you stopped leaking. You still go out, you still enjoy life, you just do it with boundaries and intention. And boundaries, they create freedom.
Which sets up the final piece of the puzzle, because the mindset only matters if it shows up in real life. So in the next segment, we're going to show you what actually looks like in motion. Same income, same market, same economy. Two different outcomes.
This is America. We don't share land here.
Education kills fear. Action builds confidence. Tell me about it, Anthony.
Yeah, so once the mindset shifts, once you realize your life doesn't have to suck, it just has to leak less, there's one more piece that makes this work. And it's the part most people skip. It's education.
Because here's the truth. Most people aren't scared of buying a home. They're scared of what they don't understand. And fear filled with bad information is way more dangerous than the uncertainty filled with facts.
Yeah, and that's the difference, right? Fake fear is built on headlines, on social media clips, on outdated advice, on wait and see. Real confidence is built on numbers, options, trade-offs, and reality. You do not need certainty, you need clarity.
And this is where Yellowstone actually nails it. When they're wrangling the herd and there's no clean way through it, they're about to drive up that mountain, there's no easy route, there's no painless option. No matter what is going to go on, it's going to be ugly. But standing still, it's worse.
That's right. And they don't move forward because the situation is perfect. It will never be perfect. They move forward because the trust of what they know themselves. They trust their preparation. They trust their experience, and they trust themselves. And that's the lesson here.
Buying a home is the same way. You'll never have full confidence in this economy. You will never control the market, the rates, supply, or politics. If you wait for all that to feel good, you'll be waiting forever.
Yeah, but when you understand the math, when you know your payment, your budget, your margin, and your plan, you stop flying blind. You replace fear with facts.
And that's when opportunity changes. Not because the market changed, but because you did. Same house, same rate, same economy. Two different outcomes.
Yeah, and this is the real version of it. Not it, I'll wait and I'll just spend. It's I'm going to understand enough to move forward. I know what I can control. I know what I can't. And the rest, it's just noise.
Because sometimes the only way forward is straight through. Not reckless, not blind, informed.
Yeah, and when you go into the unknown with education instead of fear, you don't need confidence in the situation. You need confidence in yourself.
And that's how you protect your future self. Not by waiting for certainty, but by trusting what you know and moving forward anyway. Because the American dream has never lived in the market. It's always lived in the people willing to charge forward when the path isn't clear. Now it's time for the ever-popular Rate Tracker. This is the scoreboard. This is where we look back at what we forecasted from the beginning of the year. In this case, 2026. And we see how it actually played out. Are we tracking what we cooked? Or did we leave the hot dogs on the campfire too long and burn dinner? Let's check the numbers.
Absolutely. Starting January 2026, first data point of the year. The 10-year Treasury is sitting about a 4.221, while the 30-year fixed mortgage is settling just above 6% at 6.17. That's the market right now, what we're seeing.
Since it's January and we only have 1 month on the board, this becomes our baseline for tracking for the rest of 2026.
That's right. Now, let's revisit what we projected for the 30-year fixed rate. I was a little more hawkish than you, Manley. My forecast was in the upper 4s to lower 5s, roughly about 4.75 to 5.25 on the 30-year fixed. If the trend materialized, that's what I see once we get to the end of this year.
Yeah, and I was a little more dovish. My projection was a 5 handle and about 5.25% to 5.5 on the 30-year fixed. Lower than today, but not aggressive.
I agree. And based on, where we are right now, we're still on track. Rates are off the highs. The volatility is contained and nothing has really broken the thesis between what you and I are saying. So time will only tell which one has, their horse cross the finish line first.
As we move deeper into 2026, we'll add month-by-month data, and we'll see if we're pacing better or worse than what we forecasted. But as of January, dinner is not burned. All right, before we wrap this thing up, and we heard all about Ryan's holes in his head, it's time for our last segment of the day, the Buzzword Breakdown. Ryan, thanks for keeping yourself safe.
Yep, I'm in one piece this week, boys. 5 mortgage buzzwords people hear all the time but rarely understand. Buzzword number 1 today is down payment amounts.
Awesome. So down payment isn't a one-size-fits-all. You can go as low as 0 down with certain down payment assistance programs. You can do standard programs that start around 3% down, all the way up to 20% down to avoid mortgage insurance. It's not about the biggest down payment. It's about choosing the right leverage for your situation.
All right, up next, buzzword number 2 today is gift funds. Manley, tell us about that.
All right. Gift funds are common, but they get more scrutiny. That's why the lender requires a gift letter, and we're going to document where the money is coming from, your relationship to the borrower, and we're going to confirm that this is not a loan, that this is a gift, hence the word gift letter. It's not a problem. It just needs to be done cleanly.
All right, buzzword number 3 for today is loan terms. We're talking 30-year versus 15-year and fixed versus ARM.
Awesome. Loan terms, they're about control and flexibility. A 30-year fixed, it gives payment stability, whereas a 15-year, that builds equity, but it's tighter. ARMs, they're not bad, but they're tools for temporary, and they're used when you have a plan. The wrong term creates stress. The right term creates options.
ARMs are good. ARMs are a very good thing to have. We use them to swing at stuff. All right, buzzword number 4 is inspections versus appraisals. Manley, tell us about it.
All right, these are not the same thing. An appraisal protects the lender. An inspection protects you, the buyer. The appraisal checks the value. The inspection checks the condition. Skipping an inspection to win a deal can cost you way more later on.
All right, final buzzword for today is earnest deposit.
That's right. This one gets misconstrued all the time. Earnest money is not a fee. It's a show of seriousness, and it's protected by the loan contingencies written into your purchase agreement. As long as you meet those contractual timelines and loan contingencies, you're protected. Your earnest money is protected, and it's not going anywhere.
That's the truth behind the buzzwords. Know the rules or learn them the hard way. Manley, back to you.
Get off the wall. What? Get off the fucking wall. Turn your chest to the wall.
So, when you strip all this down, this episode wasn't really about rates. It wasn't about the market. It wasn't even about housing. It was about how people are making decisions.
That's right, because what we're seeing every day isn't people failing financially. It's people freezing. Freezing because of fear, freezing because of noise, and freezing because they've been trained to protect their comfort now instead of their future later.
And the scary part is that feels normal now. Living for the moment, optimizing lifestyle, putting the future off because it feels uncertain. But uncertainty always has been there.
Yeah, exactly. And the difference is previous generations believed their future self was worth fighting for. This generation, on the other hand, they've made future feel unreliable. And so they're conditioned to cope with it now. That's the dopamine dependency loop.
And we said this earlier. The American dream isn't dead. It's never lived in the market. It's never lived in the rates. It's always lived in the future version of you.
Which is why the real shift isn't emotional, it's educational. When you replace fear with facts, when you understand your numbers, your options, your trade-offs, you stop flying blind.
And that's when the Yellowstone moment happens. Not because the situation gets easier, but because you stop waiting for permission. You look at what you know, you look at what you can control, and you say, fuck it. I'm moving forward anyway.
Best we came up with, sir, is like, fuck it, you know? Let's get up there as fast as we can and just chase some bitches down a mountain.
Fuck it. That's your plan too? Fuck it?
It's gonna be a shit show no matter what we do. May as well do it fast. Less time for things to go wrong.
If this episode made you feel or think differently, like it, follow it, subscribe, maybe share it with a friend. We're going to keep breaking this stuff down with facts, context, and zero fluff. Until next time, protect your future self.
Hey, Manley, you want to hear a crazy, interesting fact and story that happened over the weekend?
Sure, Anthony. Let's hear it.
So, I was, having some poker night with some buddies, and he was telling me how he walked into a bar last week, as he was watching that game with the Packers. And one of the patrons had a dog, and every time the Packers could not stop a third down conversion, or maybe they got scored on, the dog would do backflips and stuff. And he was like, so what happens when the Packers win and score a touchdown? What does he do? And he was like, well, he's only 5 years old, so I don't know what he does with that, but I'll let you know. And I was like, oh damn. I was like, that's crazy. Isn't that weird? Isn't that cool? The dog, he's been 5 years old, and so yeah.
Well, as per usual, Mr. Anthony here is trying to stretch a bunch of facts because, number one, the fact is he plays poker on Saturday nights with a bunch of women. Never any men other than him. And so I know that is fact. I can verify that with his wife. So there's a part of the lie that's right out the window. And number two, there wasn't a Packer game last weekend. Ta-da! Neither was there a Niners game. Ta-da!
Wait a minute. We're in agreement.
That's a first.
Girl from the heart of Wisconsin to the waves of Hawaii. Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manley's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast. Tune in, the Mortgage 101.